often it does strain family relationships, unfortunately. You do want to help that sick spouse, but when their finances get involved, as we know, money can do funny things in family relationships. And we know the biggest reason for divorces is often finances. And that's really where disability helps. Again, we're going to basically replace that lost income.
And Jonathan's been in the financial services space for 19 years. And the last 15 have been specializing in living benefits protection. And having worked with hundreds of advisors, over these past 15 years, he recognizes firsthand the value that income protection gives families. He's familiar with dozens of situations where living benefits products have staved off financial ruin due to unforeseen health crises. Jonathan, take it away. The stage is yours.
Yeah, well, again, thank you for having me. And really what I'm going to chat about today is what I'm going to focus on my presentation here for the rest of our time here today is going to be a little bit more broad because what I'm going to be talking about is health issues or health crises that perhaps aren't necessarily potentially terminal, but could impact your ability to work and earn an income. So my conversation today is going to be obviously much broader. And why don't I start with one question here to start with. What do you think is the #1 area of claim for disability insurance? What area of health do you think we get the most claims? What do you think the #1 area? Cancer? It's actually not cancer. Mental health. So actually that is correct. Our #1 area of claim is actually mental health for disability insurance. So with that, I think, Jason, what I'm going to do is, hopefully this is all going to go well. I'm going to bring up my slide deck, and I'm just going to go through sort of my presentation here. I'm going to sort of add in some stories as I go. So that's the first question I wanted to ask. So again, a lot of what I'm going to be talking about today. So a few things just to be aware of with disability insurance. Really what I'm talking about today is a health issue that would impact your ability to work. The disability insurance is a little bit different. What we're really doing is we're working your ability, we're looking to insure you basically as you're working. So basically from 18 on to basically really about age 60 is what we're looking at insuring. But just a couple things here to sort of start off with, just to sort of lay the foundation. And again, I'm going to be focusing much more broadly on sort of all of the other things that could impact your ability to work. So a couple things to be aware of. Right now, 1 in 7 Canadians have some form of disability. Now, for some of those people, it's knocked them completely off work, and for others, it's to a degree. They might be working reduced hours. They might have an impact on their ability to earn their full income. So perhaps they're working, still doing all of their duties, but perhaps instead of working 5 days, they're only working 3 days, or they might only be working, say, 2 hours out of an 8-hour day. The other big thing to be aware of is we do know that 1 in 3 Canadians prior to age 65 will suffer a disability of some sort, a health issue that's going to impact their ability to work. Of those 1 in 3 people, once it goes beyond 90 days, we know the average duration of that disability will be anywhere from 2 to 3 years. But if you take a look here at the little pie chart here, as I mentioned, mental disorders. Now, these numbers were from 2018. Now, with COVID, the mental health has actually risen, and we're definitely seeing a rise in our mental health claims. 16, 12% respectively. Cancer accounting for about 16% of disability claims, 12% cardiovascular. So that's basically your heart attacks, your strokes, that type of thing. So again, these are very complementary products, and we often get asked this question, well, is it possible both policies could pay out? Absolutely, both policies could pay out. A big thing that a lot of people think about with disability, if I mention that to, say, someone off the street, they think, well, if I'm disabled, it's if I get physically hurt. Well, it's more than that. It's really any health issue that could impact your ability to work. So yes, injuries are part of that, but as you can see here, only about 8% of our claims are actually physical injuries. The rest are sort of these other conditions like mental health, cancer, cardiovascular, and then of course we have your musculoskeletal diseases like arthritis, degenerative disc disease. That's about 5%. But the other big piece of pie is really other, and I really don't care in my world what the underlying health issue is. The question is, again, does it impact your ability to work? either that it knocks you completely off work, or there's degrees that it could knock you off work. Perhaps you're down to modified duties, what we would call a partial disability, or it has a reduction on your time that you can work, or it has a reduction on your earning ability. These are all ways that people can go on claim. We know that broadly speaking, 43% of working Canadian households have had someone take off time due to a health episode. And again, as we mentioned earlier, 1 in 3 Canadians will be off work for at least 90 days or longer. And of those people that are off work 90 days or longer, we actually know the average duration thereafter is typically on average about 2 to 3 years. Here's some other sort of big stats here. We know that 48% of Canadians are not financially prepared to be off work. And we saw that glaringly with the pandemic. 78% of Canadians, they're all saying their finances were tight. We know that's even more acute with inflation these days. And of those that weren't able to work because they had a health issue, or perhaps they were laid off, they were upset about it. Most people, they do want to be working. They do want to be doing something useful with their time. They don't want to be sitting at home, watching Netflix. At some point you're going to get bored and run out of content. Most people want to be doing something useful with their time throughout the day. Now, when someone is off work, of course, it causes stress to not only the person that is ill, but to the rest of the family. So as you can see here, 76% said it was stressful for the entire household. Often it does strain family relationships, unfortunately. You do want to help that sick spouse, but when their finances get involved, as we know, money can do funny things in family relationships. And we know the biggest reason for divorces is often finances. And that's really where disability helps. Again, we're going to basically replace that lost income. And of those that did have in a family situation, someone was taking time off, 31% said their able-bodied partner had to find extra work to make ends meet. That is incredibly stressful. Not only perhaps are you looking after your sick spouse, but now you're working extra hours. Probably not enough hours in the day to get everything done, and also perhaps also look after yourself and maintain your own health. So again, a lot of stress there on the family. Where's the money going to come from? That is always the big question. We know that 29% had to dip into their savings to pay for these expenses. 17% borrowed from money from family and friends, and they might help out initially, but how long can they help out? Sometimes we get this response. Well, my family will help out. Okay, maybe a month, maybe 2 months, but can they help you out for 6 months, a year? Probably not. 17% took on more debt. 9%, said they cashed in RSPs. But again, all of this can have a long-term effect. What is your retirement going to look like if you're taking money up today to pay for these expenses? In particular, for a lot of you who obviously have our participating whole life policy, there's a limit to how much you can take out of the policy. And then if you take too much out of the policy, that can obviously have a lot of stress on that policy, because at some point, potentially the policy might implode. So we want to also avoid that. Okay, so here's another interesting stat, and this might surprise some of you on the line here. 48% of Canadians, so these would be people who are employed. These aren't self-employed people. Canadians have workplace disability coverage. Now, what you might be surprised to know is that was down 9% from 2015. So these numbers are 2018. We actually know that number is actually even less today. It's roughly around, I believe, 46% have workplace disability coverage. We've been seeing a lot of trends with businesses in terms of trying to trim costs. And obviously this pandemic, economic uncertainty, particularly in Alberta with the oil patch, so we've seen a lot of this, companies just getting rid of their group plan. And so for those of you who perhaps might have had a group plan or still have a group plan, great. You're lucky to have coverage through work, because a lot don't. And as you can see here, over 52% of Canadians who are employees don't have coverage through their work. And of that 52% that don't have coverage, the vast majority have done nothing about it. They did not buy private coverage. And often it's because, perhaps they haven't been talked to about it. The other big thing we know, and I'm sure a lot of you probably know this already, the vast majority of Canadians would be in serious financial difficulty if they had their income stopped for 3 months. They don't have enough cash reserves to take them over that 3-month hump. And then we go beyond there, it's only a matter of time before, there's a knock at the door because you perhaps you haven't paid the mortgage, and, there's the repossessions and things like that. Just because you're sick and just because you can't work, you have a health issue that's precluding you from working, doesn't mean the bills stop. You still need to make your mortgage payment if you have a mortgage payment to be made. You have rent, you have utility payments, you have insurance premiums, you've got to eat, you've got to put clothes on your back. All of these living expenses don't go away just because you're suffering a health episode. So the big question is, who needs coverage? And the need for disability insurance is really rather simple. And one of the questions you can ask yourselves: can I retire today? Do I have money to retire today? If that answer is yes, good for you. You don't need disability coverage. But if the answer is no, I can't retire today, then you need coverage. So if we break it down, and we'll expand upon this further in my talk here today. So if you don't have coverage and you're reliant on your income, then you really need to explore your options in terms of getting some coverage there. You have some group LTD coverage, but perhaps it's not enough. So one of the big things, and we'll show this in another slide, you don't have enough protection at work. You might need some more enhanced definitions. Perhaps the definitions are rather restrictive. You might have some association coverage. Now, one of the things with the association coverage is you might not have necessarily the correct contract definitions that you might want. So you might need something a little bit more robust. Obviously, those are conversations you can have with your advisor at Ascendant, and often those questions also get filtered up to me. We're happy to take a look at exactly what you have. Perhaps you do have some individual coverage. One of the big things we always need to do in financial services is revisit what we already have. Is what we have adequate? Is what we have still suitable for our situation? Have things changed? And as things change, maybe we need to augment what we have. Perhaps you've had a big pay increase, and you had adequate coverage, but now it's no longer adequate. So again, we might need to look at topping that up. Again, perhaps you need a contract that's going to give you greater flexibility to go on claim. These are all things that we can take a look at. So those are sort of the broad areas of again, who needs coverage. Okay, so a couple of the important questions to ask about income protection, and I'm going to list off a few questions that you might want to answer for yourself. And so one of the big questions that you might want to ask yourself around protecting your own income: what plans do you have in place if you became disabled? So let me repeat that question. What plans do you have in place if you became disabled? If you had a health episode that precluded you from working? An individual's most valuable asset is their ability to earn an income. Have you protected your ability to earn an income? How would it impact your retirement if you had to access your current retirement plans to supplement your income in the event you became sick or injured? If you took a 3-month unpaid vacation from work, how would you budget to maintain your current expenses? That one's actually kind of an interesting one. I think a lot of us have always wanted to perhaps take perhaps a sabbatical and take a few months off and travel the world. But if you're going to do, like, say, a world tour, take a trip for, say, 3 months, now that, thankfully COVID is somewhat rescinding, you're going to travel to several countries, or maybe go all across Europe. Well, maybe not these days with what's going on in Eastern Europe. But let's say you wanted to go to an area of the world and you really wanted to spend a lot of time there, say a few months. What would you do to make sure you had enough cash to pay for all of that? It's really no different than if you're looking with your own income, and you'd have to plan for that, obviously. So next, let's talk about protecting your family. How would your children be affected if something happened to you? How would your children be affected if your income was impacted because of a health issue? Some of you might have children, some of you might not have children, and some of you might be wanting children. So let me ask you this. Tell me who is or may be dependent on your income both now or in the future. An individual's most valuable asset is their ability to earn an income. Have you protected your ability to earn an income? Now, this one, it's a little bit harsh, but think about this for a moment. What would create greater hardship for your family, death or disability? That one's a little bit hard there. And then also around protecting your business. For those of you who are in business, what are you doing to ensure your business continues if you can't work? What would be the income producing ability of your business if you weren't there to direct it? What is the impact to your business if your key employees do not come to work tomorrow because of death or disability? So again, these are some questions you want to ask yourself around income protection. Okay, so another way to look at this, if I were to ask you, what do you think your most valuable asset is?
my property to earn income, my health.
Correct. Yeah. Wonderful. Small town I grew up, I'm in Edmonton, but the small town I grew up is a town called Whitecourt. And if I ask that question, I might get a response back, well, it's my pickup truck. People spend a lot of money on their trucks. But again, getting back to this, your most valuable asset, again, most people will say, you know what, it's my home. Well, what I insure and what we insure with RBC Insurance is really the golden goose. And the golden goose, it's you and your ability to earn an income. If you really don't have your health, in many ways, you won't have your wealth. And so let's take a look at a person's income and take a look at it, between now and age 65. And these are some examples here that we want to show, because it's really your ability to earn an income that pays for your home, your vehicles, your vacations, the food in your belly, the clothes on your back, the vehicle that you drive. So if we took an example here of, for example, say someone earning $60,000 a year, who's age 40, and we extrapolated that income out to age 65, assuming about a 5% increase in their income each year. Well, that income earning potential is $2,863,626. Let's take someone earning $84,000 at age 40. Well, it's over $4 million. That's ultimately what we're insuring with income protection. We're insuring a multi-million-dollar asset, and that is you and your ability to earn an income. So even if your income is perhaps a little bit more modest, let's say it's $36,000, you're age 30, that's still $3.2 million. Well, maybe you're age 50, and let's say you're still earning $36,000. Well, it's still, $776,000 $776,000 between now and age 65. That's a lot of potential lost dollars. So this is what we're looking to insure here. So again, some other stats, and you've heard me kind of talking about this earlier. Again, there is a high probability. We talked about this 1 in 3 chance between now and age 65, someone will be disabled. So if we take a look here, probabilities of disability. And these are for the ones based on their age when they're coming. 50% between now and age 65 will be disabled, 40. And again, the big thing here is take a look at the average duration of those claims. So if you have a 25-year-old coming in and they're off work for at least 90 days or longer, we know the average duration is 2.1 years, age 35, 2.8, 50, 3.1. The good news is, and this is the good news, the vast majority of people who do get sick, do have a health episode, are going to get back to work. But let's think about this. If you're off work for 2 years, 2.5 years, 3 years, and you don't have adequate income protection, you don't have adequate resources to capital, what's going to happen to your financial situation? Let's see, we have because again, her stats were there. A lot of these cancer claims are people in their later 40s. So let's maybe take someone, let's say, who is say age 45. They have cancer. Maybe they're not off 3 years. Maybe let's say they're off 2 years. What we're going to do is we're going to place that monthly income. So the way disability insurance works is we pay out a monthly benefit. And then with critical illness insurance, you get that nice lump sum, whether it's $100,000, $200,000, whatever you choose, and they don't integrate. So for us, we're going to make sure that regular cash flow comes in. So you can continue to pay your mortgage. You continue to pay for the groceries. You continue to pay for the very high price of gasoline. You can pay for your kids' sports, all of those regular expenses. Let's say you do have that cancer, and now you need to pay for those extraordinary drugs. Perhaps your spouse is taking a leave of absence. There's all sorts of things that can happen. That's where that nice extra infusion of lump sum cash comes in. And again, these products are, again, highly complementary. They don't compete. And in an ideal world, in a perfect plan, you would have both. Okay, the next big area I want to talk about is around group coverage. One of the big things we often get answers back is, well, I've got coverage from work. Okay, that's great. Let's actually take a look and see exactly what you have at work. What people think they have at work and what they actually have at work are often two very different things. I've been with RBC Insurance now over 15 years. And this is what I do. I spend a lot of time, this is what all I do really, is talk about disability insurance. And I see this all the time. What clients think they have and what they actually have are two entirely different things. And in many ways, the devil is in the details. One of the big things that we see, one of the things you will see on these group long-term disability plans is what's known in, is called a non-evidence maximum. It's the maximum amount of disability protection a client can get without evidence of insurability. And maybe that's $2,000, it might be $3,000. It really depends often on the size of the company you're working for. So if you're working for a smaller company, again, getting back to the long-term disability, there's always that maximum on the plan. So let's say, for example, in this slide, let's say, for example, you have a group plan that will pay 66 2/3 of your salary to a maximum of $5,000 a month. And it's based on your base salary. So if you were earning, say, for example, $150,000, you would be covered at 64% of your net income. But what you'll notice is as your income gets higher and higher, the percentage of your income being replaced gets less and less. And this is something we call, in my world, reverse discrimination. Basically, the highest income earners in the business often have the least percentage of their income covered. The other big thing to be aware of with these group benefits plans is they often cover only your base salary. So if you have significant variable compensation, often that variable compensation is not covered. Let's say you're an hourly employee. Typically your base hours are covered, not overtime hours. So that can be a big deal. And if, for example, you have a lot of variable compensation or you're working a lot of overtime, often that extra income is not covered. So big things to be aware of. And if you're not sure exactly what you have, please go to your HR manager, ask for a copy of your group handbook, take it to your Ascendant advisor. We can certainly take a look at it and see exactly what you have. The big thing is it's often good to dust that off and see exactly what you have, because the worst thing you want to find out is at time of claim. Well, here's actually what you have. And it's like, well, I thought I had this. Well, no, it's this. And if we could be proactive about actually taking a look to see exactly what you have, and if there's gaps in coverage, we can certainly plug those gaps. But often, again, and I've been doing this a long time, what people think they have in their group benefit plan and what they actually have are two entirely different things. So good idea to really take a look at your group plan and see what you have in place. Okay, let's take a look at it another way. And again, I put in here the pickup truck because I'm from Alberta. And let's just say that pickup truck is worth $4,500. Let's say you have a house that's, say, worth about $400,000. But let's say we project your income out to be about $3 million between now and age 65. Let's say you have a decent driving record and your insurance cost is about $1,200 a year. Your house is about $1,000. Okay, so look at it this way. You've got total assets of about $445,000 and you're paying about $2,200 a year to insure them. Now, give or take, but you have a $3 million asset and perhaps you've done nothing about that. And that's your future earning power. Now, we often get the question is, well, what is it going to cost me? That type of thing. So a general rule of thumb is the premium cost should be between about 1% to 3% of your annual income. Typically, what I like to try and do is I like to keep that at 2% or less. And there's a lot of ways that we can structure disability contracts to make sure that's going to comfortably fit within your budget and still be able to maintain all of those other things that you want to do. Obviously, you need to fund your PAR contract and you want to take vacations and you want to do all sorts of things in life, pay down perhaps some debt that you have and all sorts of things. So a big thing that we try to do is make sure that that premium dollar amount is not too high and make sure that you can kind of comfortably afford that. So again, the general rule of thumb is 1% to 3%. Personally, I like to keep it at about 2% or less. I think that tends to be a little bit of a better sweet spot. And that's what we'll go from. Okay, so another way to kind of look at it is this. Is job A, job B. And if I'm sitting down perhaps with a young person and say, look, I'm going to offer you two jobs and job A or job B. Job A, you're going to get $60,000 a year, but look, here's the deal. If you get hurt or sick at job A, you're going to get nothing. Or you could get job B and it's going to pay you $58,000 a year. But should a health issue occur, you're not able to work, if you will, a disability, with job B, you're now going to get $39,000 a year tax-free. Which job would you like? And of course, if you reverse engineer this, that difference is really basically the cost of insurance. So in this case, it's on the little bit of the higher side, but again, we can certainly shave that down. But again, that's really it. Great way to think of this. Again, all we're going to do is basically take a slice of your income to ensure that if you can't work, we're going to replace that lost earnings. And again, so this is $58,000, obviously taxable, and then the $39,000 is tax-free there. Okay. Another big area that we get questions on is, I have government benefits. And yes, if you're an employee, yes, you do have government benefits, but let's talk about that. The first one that you would kick in, it would be employment insurance. So let's say you have a health issue, you're not able to work. Really the way to look at EI is probably the government's form of short-term disability insurance. Kicks in after 14 days, pays it up to a maximum of 120 days. It pays out 55% of your insurable earnings. Right now, the maximum is roughly, I'm a little bit off on this, is roughly around $580 a week. Do you think the benefits you get from employment insurance and Canada Pension Plan, do you think they're taxable or non-taxable? Again, the question is, do you think Canada Pension Plan disability benefits and employment insurance benefits, do you think they're taxable or non-taxable? So after employment insurance ends after about 120 days, then potentially Canada Pension Plan disability benefits could kick in. They pay out up to age 65. Right now, my number is a little bit off, but it's approximately about $1,400 a month is the maximum you would get from Canada Pension Plan. Again, it is taxable. After age 65, it basically just goes into regular CPP payments. Now, another area of government benefits is workers' compensation. So depending on the province you're in, it could be different acronyms. So in this, because this slide deck came from Ontario, there's WSIB, Workplace Safety and Insurance Board. In Alberta, it's WCB. If you're in BC, it's WorkSafe BC, and there's all these various versions. Unlike Canada Pension Plan and employment insurance, which are federally run, WCB is provincially run. So the maximums are different depending on the province you're in. And Dan, I believe you're out in Lloydminster. Are you not?
Jonathan, he is. He's from.
He is. Okay. So I'm going to pick on Dan here a little bit. Okay. So if anyone's been to Lloydminster, half of the town is in Alberta and half of the town is in Saskatchewan. And basically the border, obviously, it runs north to south. And that's basically also Main Street in Lloydminster. Now, let's say, for example, you're a worker and you get hurt just on the Saskatchewan side. The maximum that you would get in Saskatchewan under WCB is $65,130. That's the maximum amount of income that would be insured in Saskatchewan. Now, in Alberta, just over across the road, it's $95,300. So I kind of make this joke. If you're just on the Saskatchewan side and you get hurt at work, you might want to crawl to the other side because there's a $30,000 difference in what is covered. And basically the point I'm trying to make here is it's a bit of a hodgepodge what's covered across the country. Alberta tends to be a bit on the higher side. Saskatchewan tends to be slightly on the lower side. For example, in Ontario, the maximum you'd be covered is $85,200. BC, it's $78,600, and every province is slightly different than the next. So again, just because what you're covered in one province isn't necessarily what you'd be covered in another, because again, each province has their own WCB board. Okay, some other questions you might want to ask yourself if you are fortunate to have benefits at work. And again, if you do have benefits at work, you're of the minority, because only roughly about 48% of working Canadians who are employees actually have coverage. So the first question you might want to ask yourself, is coverage 24/7 or just business hours? And what I mean by that is, if it's just business hours, basically what it means is all you have is WCB coverage. Because with WCB, you're only covered at work. You're not covered driving to work. You're not covered driving home from work. It's only on the job that you get yourself hurt. So with group, it's going to pay 24/7. It doesn't matter where you get hurt or sick. And that's the thing we want to make sure that we're looking at. So that's where you'll look in your group handbook and see exactly what you have, or for that matter, might not have. Is there a maximum monthly benefit amount? Yes, there should always, for most group plans outside of government, there typically will always be a maximum amount that is covered. Now, again, as I mentioned earlier, typically if that's a larger business that you work for, that maximum might be higher. If it's a very small business that you're working for, it might be rather low, and it can really range all over the board. It might be a low of say 1,500 all the way up to perhaps 12,000, for example. The next one, how is disability defined? Now, what you'll typically find with some group plans is they're, to a certain extent, they are somewhat restrictive in the definition. That is done by design. The definition is often what we call total disability. And what that means is you're completely gone from work. And for many people, this definition, that's fine. That's reasonable for them. For others, that might not be. I do spend a lot of time working with some executives, and that just doesn't give them the flexibility to go on claim. So sometimes with executives, leadership teams, we sometimes augment their coverage to give them more robust. But for the vast majority of people, a total disability definition is somewhat satisfactory. Are bonuses covered? Is variable compensation covered? Often it's not. Sometimes it is, often it's not. You'll know if you look inside your group handbook, there will be what's known as the definition of earnings, and that's what you want to scrutinize. What earnings is covered, what earnings are not covered. Is the coverage portable? Often it's not. So for example, if you leave your employer, and let's say, for example, you have some group life insurance with your former employer, typically you have 30 days in which to basically take that group coverage and put it into an individual contract. That's not typically the case with disability insurance. Some carriers allow it, the vast majority don't. So again, just because you're leaving your employer, often, again, you're not going to be able to port that coverage with you, but it is important to obviously have coverage wherever you're going in the future. Okay, I have coverage with another insurance company, and great, fantastic. You have some coverage. How long ago did you buy it? Is the coverage up to date? Is what you bought several years ago, is it suitable for your current situation? So again, we might want to dust off that contract. Let's see exactly what you have in place. Were all the underwriting considerations fulfilled? So one of the big things that we run into in our world is a thing called creditor protection. Often creditor protection, for example, if you have disability coverage on your loans or your mortgage, often what that coverage, how that coverage is assessed is at time of claim. It's what's known as post-event underwriting. So they don't assess you at when you purchase the coverage, they assess you once you need to file a claim. And if, for example, you had some pre-existing conditions, it might be questionable whether or not it's going to pay out. So not to scare you all, but it is something to be addressed. So if you are paying for that, perhaps some of that creditor protection, really might want to encourage you to reach out to your Ascendant advisor, and let's perhaps talk about getting you some more robust coverage there. Okay, so I'm gonna finish this off here with basically these two questions. What is the likelihood of the event happening to me or to you? And if it does happen, will it result in a major financial loss for you? So as we talked about earlier, we know that there's a 1 in 3 chance that between now and age 65, you're probably going to be off work for a period of time. Again, it could be up to 2 to 3 years. And what kind of financial loss will that look like for you? Often we insure things, for example, like the extended warranties. Like for example, let's say you buy a television at Costco or at Best Buy. They're always going to ask you if you want to purchase that extended warranty. But let's say, for example, you didn't purchase that extended warranty, and let's say your TV did break down. What's the impact to you financially? Well, you have to buy another TV out of pocket, but in the grand scheme of things, how much dollars are you going to really be out, if you will? But if you can't work for several years, now what's going to happen? and what impact is that going to look at your family like? Pick it up with Jayson.
Awesome. Jonathan, thank you so much. And to all of our clients, you made the right decision to be here today. I want to encourage all of our clients in attendance, all of our clients who are viewing this in the future, connect with your advisor and have the conversation. Alternatively, you can expect follow-up from us. We will be in touch with all of you. We are going to be launching an Ignite campaign in our second quarter, and our advisor team are going to be proactively reaching out to clients to open the conversation, to really understand what questions you have, what additional clarity that you need, and then examining what would be a perfect complement to what you're already doing financially so that you can be even better prepared, heaven forbid, if you became disabled, if you experienced a critical illness, or worst case scenario, both.
What about self-employed with no coverage and no WCB coverage? Or it says no coverage and then just says WCB coverage. So I'm not sure if that means there's no WCB, but point is self-employed person with no coverage.
Yeah, this is a great question because we do insure a lot of self-employed people. So maybe I'll give an example here. One of the big things we run into is guys who are on contract, but they work in the oil patch. So, perhaps they're subcontracting, like, for example, like with CNRL or one of the other big oil companies, Suncor, Imperial, Shell, what have you. Often they have to have WCB coverage just to get onto the job site. That's a requirement. They don't care if you have individual coverage. The oil companies don't care. You must have WCB to be on their job site. But again, you're only covered while you're on the job site. So you really need to have coverage outside of that that's going to cover you 24/7. So that's really where an individual contract will help out. So for those people who are self-employed and you have an incorporated company, and perhaps you pay yourself dividends, we look basically at your corporate financials to basically determine your income. So I guess I'm getting a little bit farther down the road here, but that's one of the big questions. That's the reason why I'm asking it, because a lot of self-employed people say, well, I just pay myself dividends. And don't worry, we can look at that and make sure that you're adequately covered.
Jonathan, may I chime in just because we're on the topic of self-employed people?
Mm-hmm.
Often what happens is, we get chatting with people and we discover that, last year they were employed, but they had a great opportunity and they decided to become self-employed. And now they say, hey, now that I'm self-employed and I have my business, I don't have group benefits anymore.
Yeah.
Gosh, I'd love to get some critical illness and disability in place. The challenge with that is obviously the income, right? We need to have some track record of income.
Yeah.
So I just wanted to preface that by saying, what if that exact same scenario happened? I'm employed today, but I do have a disability policy. So maybe I'm considering becoming self-employed. Is there any benefit to me maybe looking at getting a disability policy while I have income? And then can that policy be taken away should I decide to become self-employed later and now I don't have an income to protect on paper?
Yeah, it's a great question. It's a big question. And there's a lot of facets to that. So to start off with, yes, if you're, say, for example, an employee and you're perhaps considering or contemplating becoming self-employed, perhaps starting a business, yeah, you might want to proactively look at putting in place a policy. And without getting into all sort of the technical details, there's ways that we can perhaps structure it, perhaps a little bit to start with, and then we can grow it once you leave the business. Now, there are situations where they've already left their employer and now they're into their new business. And we do have limits on what we can give while they're basically in their first year of business. We take a look at a lot of factors. So, for example, is it a continuation of what they were doing previously? So we see this all the time in the oil patch, for example. They're doing this job, but now they're on contract. It's essentially a continuation of what they were doing previously. They're just now on contract versus being an employee. So typically we can use their last year's worth of income to go based off of that. It's different if it's a brand new business, like a completely different area of industry. For that, we might have to give a lower limit initially until we have like at least a full year under our belt. So there's kind of ways to kind of mesh things together. But as you have those scenarios, definitely kind of obviously talk to your Ascendant advisor, give us the details. We can certainly look at putting in place what we can. Another area to perhaps talk about with those business owners is always look at, you have basically two sides of the coin. On the one side, you have your income, basically you have your home responsibilities, your personal financial obligations. But business owners also have another set of obligations, and that's obviously their business financial obligations. So again, depending on the nature of the business, we might also, there's other policies to cover those fixed expenses of the business. So there's a further conversation to be flushed out there, and exactly what is that business going to look like? What expenses are you going to be looking at down the road? Are you going to be in a partnership situation? There's all sorts of things, further financial planning to be had. But again, reach out to your Ascendant financial advisor.
Thanks, Jonathan. So the point is the importance of having personally owned coverage, because once I own that coverage, it can't be taken away. Is that a fair?
Yes, that is correct. That is correct. Once you have it, we can't take it away. And even if there's a job change, I mean, it does happen. I mean, we insure some doctors and then they don't like being a doctor anymore and they decide to open up an Airbnb or something like that. It doesn't matter. Once that coverage is enforced and they change things, we can't go back and change things. It's locked. Yeah.
Thanks, Jonathan.
Excellent. Thank you.